Research into behavior has revealed over 100 different kinds of bias that can affect our decision-making. Recency bias. When we try to predict the future, we naturally look at the past. But our brains most easily remember what happened recently, so recent events carry greater weight when we try to formulate decisions. This can be valuable in our day-to-day life, but it rarely works well when it comes to investing. If the value of an asset we are considering has been increasing significantly over the short term, our natural bias is to believe it will continue to do so, despite information to the contrary. Herding behavior. There are several good reasons why we should follow what other people do. Obviously, we want to obey the law, obey the rules of the road, and vacation in Hawaii if everyone we know gives it rave reviews. However, in the investing world, there are times when following the herd could be our undoing. During times of volatility, everyone's biases tend to be exaggerated, and we can get drawn into bad decisions by following the herd. It is also related to fear-based behavior, particularly the concept of FOMO, or the fear of missing out. Action bias. A common theme of business coaching today is that to produce results, we must act. In times of stress, most people prefer to take some form of direct action rather than doing nothing. At least they can say they tried. But in the world of investing, sometimes doing nothing is statistically the correct action. It seems counterintuitive, particularly if the markets are dropping, that sometimes the best decision is no decision at all. Overconfidence bias. Even though we know that when markets are efficient, it is extremely difficult to beat the market makers. Even the best portfolio managers sometimes struggle to outpace the market indices. But most individual investors trading on the market have the confidence that they can do better. Otherwise, why would they try? Unfortunately, this overconfidence is another bias that can affect decision-making. It can create unrealistic optimism and rash decision-making since we believe we are a cut above the rest and will be spared the suffering that others will endure. Confirmation bias. Most online investors and traders claim to do a lot of research before they make an investment decision. This is a good thing if we can avoid confirmation bias. This is the tendency of our brains to look for and interpret information in a way that will agree with our current beliefs. It is best to leave your opinions behind when doing market research and to look at the facts and data as objectively as possible. Loss aversion. Perhaps the best known behavioral bias is loss aversion. For most people, experiencing a loss generally feels twice as bad as receiving a gain. If we are not careful, this bias can cause us to exaggerate our losses while at the same time not properly recognizing significant gains. The best way to avoid this bias when investing is to have a plan and stick to it, particularly when it comes to long-term goals and stop-loss selling. I'm Randy McCord with National Best Financial Network. If you found this content of interest, then perhaps we should have a conversation. I can be reached on my mobile at 403-470-5254 or via email at randy.mccord@nbbn.ca. And please subscribe to our channel for more interesting videos on financial protection and planning.